Hello everyone, welcome to the session. So in the previous session we have learned a few terms including expenses, expenditure, how expense differ from expenditure, and what are assets and liabilities. Now we are going to see the most important concept that we will be using quite a lot in accounts. It is profit. So profit means nothing but the excess of revenue of a period compared to its expenses, which means the difference between revenue and expense. If the revenue is more, it's called a profit. So revenue we have learned already. Whatever the company receives, whatever the cash or asset the company receives from outside, it's called revenue, and whatever the company pays is called expense or expenditure. Okay, so depends on it is short term or long term. It could be expense or expenditure. It could be a liability or an asset. So therefore, if the company during with the help of its business receives about rupees 1 crore in the past year 2019-20, and at the same time it has spent money of rupees 50 or 60 lakhs, it means that it has an expense of 60 lakhs and a revenue of 1 crore, and profit would be 1 crore minus 60 lakhs equal to 40 lakhs. So that's how profit is calculated. But there is quite a bit of details that we need to calculate before calculating the profit, that we can do while we are preparing the profit and loss statement. Okay, but for now, as per the definition of profit, profit means if the revenue is more than the expense and the difference between revenue and expense is called a profit. So if you have profit, means you can use the profit to give it to the shareholders, or you can use the profit to reduce your liability, or you can use the profit to invest in your business itself to increase its profit for the further years. If you have two machineries manufacturing so and so products right now, you can buy one more machinery with the profit, and then you will be able to manufacture more products, thereby earning more profit. So that's why profit are used. Gain means a profit that arises from events or transactions which are incidental to business, such as sale of fixed assets, winning a court case, appreciation in the value of assets. Actually, gain is different from profit because profit includes all the revenue that is acquired by the business. So profit, all the revenue in the sense, if you if you are selling water bottles, okay, you if the everything that you earn from selling water bottles is called sales income, right? So that's called the selling income. And other income that you have will be you can rent out a property, that's called a rental income, or if you can lend a loan to someone else for which you can receive interest, it's called interest income, along with other incomes such as investment incomes, so on and so forth. So but gain would refer to if you are selling your asset for a higher value than what it is worth, it's called gain. So for example, you have a company car and that car was bought for 5 lakh rupees, and after depreciation for the last year, the car is now worth 4 lakh rupees. But let's say you're able to manage you manage to sell the car for 4 lakh 50,000 rupees. That 50,000 rupees is your gain. Actually that in accounts and in tax there are different definitions for gain. Most of the times we will see gain as the difference between what we have purchased and what we have sold it for. If we buy an asset for 10 lakhs and we are selling it for 15 lakhs, that 5 lakhs is our gain. But in taxation, the whole 50 lakhs is considered as a gain. So whatever we receive from sale of fixed assets or by any other means, like for example, we if we have insured our car for 5 lakh rupees and our car has met with an accident and the insurance company pays us 5 lakh rupees, that's also a gain. And if we have bought an asset for 10 lakh rupees and suddenly the value of the asset has increased about 20%, and that whole 12 lakh rupees will be considered as a gain. So there is a difference in definition in taxation and accounting, but for the most part we will use that the word gain as a profit arises from such events. Loss, on the other hand, if the expense is greater than the revenue, it's called loss. So the loss is obviously, I mean, you will have a revenue of 5 lakhs and expense of 6 lakhs means you need to pay one more lakh. So that one more lakh is reduced from the owner's capital. The owner's capital is nothing but whatever the capital that has been invested by the owners at the beginning. So that forms part of the capital. So why loss is bad for business is it reduces the net worth of the business by reducing the capital of the business. So it's not only cash, it's also any other losses, like for like I said, if the car has met with an accident, whatever the money you have, whatever the value of the car that has been reduced from its beginning is a loss, so on and so forth. So if you lose products by any theft or fire accident, that's also included in loss.